Hey guys, welcome to my channel. My name is Michelle, aka Your Finance Girl, helping you to do finance better. So if you've been following the news, then you already know that the UK released a mini budget last Friday, which released all kinds of beasts in the market. You saw the pounds plummeting to 1.04 low to the dollar, equities markets being slammed, and bond markets sold off aggressively. Now, there's a new saying in the market that says UK is now an emerging market and the pound is the new peso. Well, they aren't wrong if you look at the way it's been trading and the macroeconomics of the UK. So in this video, we're going to break down all the reasons why that the pound is plummeting and why it might face continuous pressure, as well as in the very real term, how that might impact you in terms of mortgage rates and inflation of goods. So before we begin, this is not financial advice, so please act and invest at your own risk. So the market round actually started before the UK mini budget was announced, where we were expecting a fiscal stimulus package, where we were expected to see tax cuts as well as NI tax reversion. But the surprise actually came from Chancellor Kowalski removing the top 45% tax band, as well as the stamp duty relief for the housing market. Now, there's been little mention as to how the UK is going to fund this, because this is estimated to be worth £161 billion over the next 5 years, plus another £40 billion on top of that from the energy bill that Liz Truss announced earlier. Now, the UK reaction and the market reaction can be described as an emotional one. So let's take a look. So here we have a graph of the FTSE 100, which is the top 100 companies in the UK that are listed. And you can see that just before the UK mini budget was announced, right here, it sold off 2.27% and accumulating to a almost 7% downturn since the anticipation of a fiscal stimulus. Now, you might be asking, isn't the fiscal stimulus good for the economy? Yes, if we're in a low inflation and low interest rate environment, but it is highly unusual for a government to be pro-growth, which is what the UK government is trying to do in an environment where we're seeing super high interest rate, hyperinflation, because this will force the UK Treasury to issue more debt and print more money, which then in turn depreciates your currency and adds to the underlying inflation. To give you an exact flavour of the chaos that we saw in the market today and over the last couple of days, if we look at the pounds, it's been trading down in a downtrend trajectory for the year to date anyways, but nearing the announcement of the fiscal stimulus, we're seeing it taking another leg down around here. But the real kind of downturn, sharp term, is from last Friday, and you can see it actually dropped off of the range that it's been trading for this year. So let's look at another metric. So let's look at, I'm going to show you here, just show you the downtrend projection channel. So if we started off the year here, actually we can start off there and kind of just doing the same projection here, and then take it down with our resistance levels. So let's say that was a good kind of resistance level there, and I'm just going to delete the previous channel. So as you can see in this kind of red, I don't know if you can see it on my screen very well, between the first red line and the second red line, this is where we've been trading for the year in terms of the channel. And this latest leg right here actually broke through the year-to-date range. And what this means, it means that it broke through the resistance level that we set for this, around 100% there. And if we look forward, it means that potentially the pound could continue to depreciate to about exactly 1-to-1 with the dollar here, and the Bank of England cannot intervene and does not hike rates fast enough to rein in inflation. Now, I hear you might be asking, okay, isn't a weaker currency good for the UK economy? Good for the fact that it's good for cheaper for export? Well, yes, if you are running a current account surplus, i.e. you are a net exporter, then yes, then a weaker currency would help you. But unfortunately, the UK is a net importer, i.e. we run a current account deficit. So we borrow more than we receive. So in this sense, a depreciating currency actually erodes your purchasing power even more. So for example, to put it in very real terms, what does that mean to you? Well, the UK is, some of the biggest UK imports are oil, cars and parts, machinery, fruits and veg. So for that, in terms of for everyday people like us, then everything automatically de facto is going to get more expensive from here. Well, okay, so what does the market think? So Crispin O'Day, I don't know if I'm pronouncing his names correctly, a London-based hedge fund manager who manages over £4 billion of assets, have been shorting the pounds ever since Brexit. He's made £220 billion in one day on the day that Brexit happened, and he's been adding his short positions. And he says that we might not seen the worst of the pounds yet. So the real question from here is that, can the Bank of England intervene and to kind of support the pounds? The technical answer is yes, but unfortunately, Bank of England just does not have as much firepower as the Fed, for example. And there are other times in the pounds where it's dropped at an even faster rate, and Bank of England did not intervene. So the bar is set pretty high. So if I just show you here, so I'm just showing you the graph of the pounds again, but on a zoomed out 5-year basis. So you can see that, back in 2020 when we had COVID, or back in 2018 when we had a really sharp drop in one day, the Bank of England chose not to intervene. So the bar is set pretty high here. So the only thing that we foresee Bank of England can do is via the monetary policy. And the only thing they can do is to increase interest rate in an attempt to control inflation and bring it down. But we recall that the Bank of England actually called an emergency meeting yesterday because of the pounds been falling and even worse sell-off in the bond market. Unfortunately, there was nothing meaningful that came out of the meeting, and the language of which was very closely watched by the market, and they said that they will closely monitor the developments of the financial market. Now, unfortunately, the market was not very happy with that, and you actually saw another leg lower in both the equities markets, FX, and also fixed income. In particular, now the expectation of Bank of England hike is actually even higher, where we're expecting at least 1.5% of hike by the next meeting, which is on 3rd of November, and a total of 2.5% by year end. And now what does that take us? Well, it takes us to a terminal rate, i.e. a rate they think where inflation will be moderate, of 5.5%. Now, that sounds crazy because 5.5% is actually higher than what the market is pricing, expecting for the Fed, where the US market is actually more robust than the UK market. And this has very real effect on UK mortgages. So a few of the major UK lenders this morning came out with a statement that they're actually stopping lending mortgage to new customers, and some of them has withdrawn some of the products they have available to customers. And these lenders include Skipton, Lloyds Banking Group, as well as Virgin Media, so your everyday kind of, big banks. And unfortunately, that means that for new borrowers, your mortgage rate is likely to be very, very high, and you were likely to need a bigger deposit when you could have borrowed that very easily in normal times. And this also means that the stamp duty relief that we have for the first-time buyers is actually very small and kind of diminishing because of the high interest rate. One thing to point out is that actually approximately 74% of the UK mortgages are on fixed rate. So mortgages actually on a bit of a lag in terms of erosion to people's real spending and real income. So particularly maybe in a year or two's time, that's when we're really going to see the effect of the high interest rate when people are having to remortgage. So in fact, the mortgage default rate and a raise of payments to UK banks is something that we should probably keep a really keen eyes on, because that's going to be the indicator of whether, if the UK goes into a recession, how deep the recession will be. And we obviously don't want a repeat of 2008 when we got the mortgage defaults. So that's probably like a more medium to longer term effect or indicator we're looking at. But for the next month or so, until the next Bank of England hike, we will be expecting the Bank of England to be very hawkish, to hike something meaningful. So at the moment, the market is looking for 1.5%. Something realistic will be something between 0.75, so 0.75% to 1%. So that's something that's probably more realistic and doable. We'll be also looking out for the new inflation data that's coming out. So that's CPI, PPI, Rightmove housing price, as well as kind of retail sales and service PMI. If it's a softer print, i.e. if it's lower than previous months or lower than expected, then we should probably see a relief rally in the market. But we're going to keep you all up to date here and follow it up. So please make sure that you are actually subscribed to the channel to hear all the updates. So the video is getting kind of long, but if you found this video really useful or insightful, then please make sure that you are subscribed to the channel, like this video, and also turn on the notification bell, and comment below on what you think the Bank of England should do, or what do you think the next hike is going to be, and tell me what topics you would like me to talk about next. So until next time, I'm Michelle, aka Your Finance Girl, helping you to understand the financial markets better. See you!